Good afternoon. Welcome to Options Tender. It is Tuesday, turnaround Tuesday. Not really. I don't see much turnaround, but we have FOMC tomorrow. We had CPI came in line today. Looking at, well, first of all, I want to mention I had to reinstall the Thinkorswim, and I lost a lot of my workspaces that we have on these. So as I rebuild them, I'm going to figure out how to. I'm starting to share them now, and so I have them on the internet and stuff like that, so I can share those with anybody if they find something interesting that they would like. But so I started. I have 3 so far, and we're going to take a look at those as I do these, and I'll put on a few more tomorrow, 1 or a few more tomorrow. We'll continue to build on these, and I'll show you them as we go through. For example, the last video I did was with volume. They were with all volume indicators, and there were several on there that we could take a look at, and I'll rebuild that one eventually as well. And these are all things that I use for my analysis on the overall market, along with traditional market analysis and Elliott wave. So today, we're going to go through those 2 indicators, and we're going to have a little bit more focus on the dollar. I'm going to give you a point of view. I'll give you a traditional analysis of the dollar. We'll go through a comparison, and that's one of the indicators that I was showing on there, one of the workspaces, a comparison between SPX and the dollar and how they typically correlate. And then first, I'm going to just go through SPY from the monthly all the way down to 65. So stick around for a lot of good information. If you're new here, go down to the bottom right hand corner, hit that Options Tender logo and subscribe. And don't forget to like the video. If you want to do anything to help this channel, please like the video. It's one of the best things you could do. There's further ways that you can help down in the description if you'd like. Free Discord, things like that. We have a consolidation area on the monthly time frame right here. Okay, we had a monthly, we're sort of breaking out of that consolidation zone. So this is a good point of reference. You can draw a box around this. And we'll kind of change this color, then we can use this more often. Okay, so change the color. There we go. Okay, that helps. Now we have this box, the consolidation here. We can draw another box here where same thing happened. We're kind of mimicking that side. And we're sort of breaking out of this zone here. And also we have that pivot that we drew earlier with these tops here, and this one wasn't a reversal, so we're still just calling it a pivot. We're holding above that pivot. Now I'm really watching this area that happens to be the 457 zone, because if we break down from the zone, that's going to be a fake break, and we should have a pretty violent move to the downside, or at least at minimum to retest the bottom of this zone. So with all the divergences that are happening, and I'm going to show you with the dollar and a little bit of TNX and the VIX, with a little bit of that divergence happening, I do believe that's a possibility. Now, if this breakout is true, then we're not going to really, we could visit back under here a little bit, but we're going to jump back out, and we'll look to test the highs at minimum. So that's where price wants to go at this point. Okay, that's where price is driven to go to the all-time highs as the next point, as this is technically a breakout. Moving down to the weekly time frame. I had to build these time frames back up as well, so I'm just going to do the max, but we have this pivot all the way down here, and I do think we will visit that pivot at some time. So the important thing on the weekly time frame is to see we had our large correction here, and we're looking, price action was getting tight, and is again, technically breaking out, and it's pushing and grinding to the upside, but we have divergences all over the place. So we'll see, does this continue to just keep grinding? I don't really think so. There's lots of reasons to say. There's out there on FinTwit and on a lot of the analysis of some wonderful people that I follow. There's CTAs. There's a blackout period for buybacks. All sorts of things that say we should be pretty bearish going into the beginning of January. We'll see if we get that turnaround tomorrow with the FOMC. In the meantime, we continue to push. We're bullish. We're just we're setting records here. We have 1, 2, 3, 4, 5, 6, and so far 7 weeks straight up. Now you could call this sideways for a minute, but we actually made a higher high here. So 7 weeks up. It's pretty astonishing. On the daily time frame, trend is our friend. This gives us a little bit different of an optics here. We have a rising wedge that we're depicting. We don't have to touch the top of the wedge. If we do it recently, if we continue to go up and we do it recently, we'll have an exhausted market going into resistance, and we'll continue to look for reversal. And I do think we'll test the bottom of the wedge and or break down, but we'll need to probably the same mechanics that move this straight up can just go straight down. But really, idealistically, we'll be looking for a reversal, a bounce somewhere, and a continuation to the downside. That's my primary scenario that I'm going to continue to talk about. And then the secondary scenario is that we get some sort of pullback and then reach all-time highs, possibly an overthrow to reach that all-time high and a breakdown from there. Those are the primary. There is a bullish scenario out there, but that resolves in some sort of pullback as well. And then we can bring that up in the future if need be. Okay, we're not going to look at any of these indicators. We're really just looking optically at these markets. Going to the 65-minute, this will give you a little bit better picture. We hit that 12. The 12. I'm going to show you the VIX. We just had our alert, so we're gonna put on a trade on the VIX. We're gonna go long the VIX here in just a minute. But we broke out from this wedge and just straight up. But we have a widening. You can call it megaphone. You can call it like a widening triangle, whatever you want to call it. But it's wedge. We haven't just are just a few ticks away from reaching the top of that wedge. So, and I think that will be our reversal zone. So that's what we're looking for here. I don't think we'll complete the gap here. If we do, that can just be an overthrow and head back down. But it's kind of expected after we broke out from this little downtrend. We're just grinding to the upside, working into FOMC. I didn't know if the CPI would be a catalyst to the downside. Of course, we gapped down and closed it, but we didn't really show any sort of break in structure either way. But we're forming a little bit of a wedge here in this widening wedge or megaphone. We're just about to the top of there. So this is a good spot for us to add on to our puts. And that we will do. I'm going to adjust these boxes here, but essentially they're going to stay the same. It's going to move up just a few inches. I'll check it out later. But this is our zone. This is where we'll start to take profit on any pullback. We can make it all the way back down to this wedge that we broke out from, and or the rising pivot here from that rising wedge that we were talking about earlier. But that's just a lower point that we looked at on the daily time frame. So this shows an end possibility to this move, and how it's just grinding. There's no real impulse like these here. It looks like it's just trying to find a home, to where a destination, and then reverse from there. I know this has been arduous, especially if you've been in my camp where we've been short and we're really, time. We have most of our bigger positions, we have until the 29th. I think that is, and this, if we reverse from here, it should be pretty sharp. So we're looking good we have the 22nd, 29th, and then we have more positions out to January that we'll add on to today after we get off of here. So I think that's it with the 65. This will be our take profit zone. There is the 434 that should create some sort of bounce. We have some pretty good consolidation zones there, and I believe that's the 50% retracement. So we'll go ahead and look at that. The 434. So that's always a nice spot to take off something off the table, but our real zone is going to be our former 382, our 618, and then our current 618 retracement. Those are a big cluster of areas that I think will make good support there for at minimum a bounce. Okay, so we take, or we can add protection, call protection, depending on the indicators. But I think this is a really good spot to take off profit, because we should see at minimum a bounce. Sold into would be the primary, and the secondary would be to continue up for all-time highs. And you can watch that video. It's the last video I made. Where we're not looking for we're looking for a time frame in between January and March for between now really and March for a reversal, that time period. So if we hold this bounce, you can look on the video for a much more thorough situation. We hold this bounce and we go to all-time highs. I think that needs to be done before March, and that kind of fits that scenario just as well as us reversing now. The market's going to force us that way. We're gonna see a chain of character with TNX if we start to see that start to fall with the market falling, and I'll show you those comparisons. So first we'll take a look at VIX. Take a look at VIX on the daily time frame first, and we'll go down to the main thing, down to the 65. The main thing I want to show you here, make sure you hit that notification bell, by the way. We do these videos often, and you definitely want to miss. This is like a storyline. We build a story. We get more information each and every day, so we can create our story and sort of predict or give probability of what might happen next, and that's how we trade. So we made lows that haven't been touched since 2020, 2021, something I heard out there. I'm not really concerned about that, but this 12, that's an extreme complacency historically, and I can show you where that came from. I'll just go to the weekly. It's just been a spot where you have consolidation around, and these are extreme areas, and a lot of times you tag it and you move up, or at least get a bounce, or you get a bounce. Even for the larger moves, this has been quite the area. Now, when you get those real rampant, relentless moves to the upside, you're going to have this, and that's going to be extreme complacency, and we saw that in 2018. But since then, we've just excuse my voice, we've just tagged these areas and bounced, and even had the Corona crash here. And so we're right back at that zone with extreme readings. That's why I want to go long. We'll probably use the VIX, DXY. I use that sometimes in the short term, but VIX, and then also add on to our SPY puts from this point going into FOMC. This could go just a little bit further. Could we tag the bottom of the channel? Possibly, but it shouldn't stay below 12 for very long, meaning days to, I don't believe we should see any closes weekly down there, but we'll see. All right, so we're right into that zone. Let's go down to the 65 and see if we can see anything different. And on that 65, we're drawing this as if this is the bullish for the market scenario. We had this wedge that we broke down from. We're forming another wedge, so we should break from this wedge, from this extreme complacency zone, back to us, fill some of these gaps, possibly even come all the way back up to 19. That'd be a good resistance there. That would be considered a back test of this wedge. And at that point, if the market needs to go to all-time highs, that's when we should see a move back down. Whether we make a higher low, that's a whole nother story, but it should come to test these lows here, extreme complacencies during all-time highs. And if we're making a higher low near all-time highs and we start to break all-time highs, but the VIX is making a higher low, that will be a divergence that we'll be looking for that reversal, that last breath, that last move. We'll see what kind of time we get out of that. Okay, now I'm gonna go ahead and switch over to the comparison. Okay, so here's the comparison chart that I want to show you with the dollar. I know that these lines don't show up everywhere around here, but okay. So essentially with the dollar, back here, the dollar spiked, the market spiked to the downside. So that's our inverse correlation there. And as the dollar went down, the market went up. So that's very typical. And then the dollar started gaining steam, giving us a divergence. It started to go with the market and eventually broke the market to where we got to a point. And that's where these lines don't really match here. I had to, as I move I'll leave it on the screen. So after we got to a certain point where the dollar peaked, the market, it took a second. It got a lower low after the dollar peaked. And so that marked a reversal for the market. So it gave the market the chance to move up as the dollar went down. So that's our comparison here. And I'll move these lines back. Now, as we made our bottom in the dollar bottomed first. If you notice right here on the 12th, the market still went up just a little bit. So the market has a late reaction to some of these turns here. So we have to keep that in mind. And then the dollar started going up, the market started to go down. Now, this brings us to now. And as I readjust these lines here with the comparison, the market is continuing to go up. The dollar had already bottomed. So we're looking for a turn in the market. And then I'll show you a quick analysis of the dollar and show you why I think the dollar is going to continue up and possibly even make new highs. Now, whether or not it makes new highs or not is not important. It's looking to move up. Whether it's just an ABC pattern and then it heads much lower, that could be. But either situation, the dollar should move up, the market should move down, probability wise. Okay, now that's the main thing I want to show on a comparison, but I'm while we're here, TNX has been on our videos a lot more recent, and I just want to show you that TNX, the 10-year treasury, it usually moves along with the market, and we've had certain times it usually correlates, but the important thing right now is that we've come into an inverse correlation period where the market goes down as rates go up. So people consider the rates bad for the market right now. That's going to change. Okay, TNX has been going down, the market's been going up. it's fine. That can continue to do so. If TNX starts going up again and the market corrects, fine. But the bad part is when they correlate again. That's when you get the situations with here, as the market goes up with the rates going down. Eventually, the market says, "Oh my gosh, something's wrong with the economy," and rates tank. The market tanks. That's the acceleration point of the market. That's what I'm showing you now. We'll go back to 2008. Same thing. Rates are going up, market's going up, and then rates start to plummet. And that's when you start seeing the market diverge and say, hey, wait a minute, the economy is not good. We're having, and you can call this, the Fed pivot and things like that. It doesn't matter. The Fed is everything really, but it's the market that drives the Fed. So, when I translate this, it's really rates are tanking. That's all that matters. And then the market starts tanking with it because the economy is deteriorating. Okay. I'm a believer in the fact that the market is a true driver of the Fed. The Fed just has to follow suit and try to bring the short-term rates along with the market. So if the market forces the rates down, the Fed has to do the same thing with the short-term rates. Okay, so it's all driven by the market. So we had a peak in rates here. The market continues to go up, thinking rates going down is good. That's what's happening right now. Market goes up, and then you break at some point. Rates start to head down. Market made a lower high, but thought it was good for a minute. Rates continue. At some point, it breaks the market, and the market accelerates to the downside. And in this case, continues to move down for quite some time. Eventually, the market bottoms, rates bottom. The market actually bottomed before rates. So you can see the turn there, and eventually just moves up with the rates and saying the economy is starting to come back together. The economy is coming back together. And then, of course, it happens again in 2008. But that's what I want to show you on this. That's the important comparison on TNX. And I'm going to bring up the dumb money indicator. Now, here's what I call the dumb money indicator. We have somebody else named this a while ago, so I thought that worked out perfect with this. And I can't remember right offhand. I tell you, I watch other analysts as well. You should as well. I love comparing to what other analysts, Alessio, a lot of people out there, Ron Walker. I love all these guys, and I disagree with them sometimes, and they seem to be right a lot of the times, but they are wrong sometimes as well. So I like to compare. Anyway, we have SPY, which is considered the dumb money. You see price heading up in the late comers to that retail would be the bag holders continuing to the upside, while HYG, the junk bonds, high yield, is starting to back off. So you have that divergence here where the smarter money is starting to back off, get out of those high yields, and leaving the bag holders to reverse later. So we have our lower low here on SPY or SPX or ES, and then we have a higher low on HYG, junk bonds, and that's when risk on starts to happen. You can see it happen here first, and then starts to spike up, and the market it follows suit really quick there, and we'll look for the same kind of move. Now, this continues lower. We will see this break at some point, and tomorrow would be a good catalyst for that to happen. So look out for that. Especially if you're long right now, this is really not the place to be holding long positions, at least without protection. Now we're going to go back to the dollar and end our video here. Okay, bringing up the dollar one more time. We had this huge support area, broke down from it, fake break, accelerated relentlessly to the upside. That brought the market down. And then as the dollar backed off, that's when the market started to rise again. So what we're looking at right now is to see what's happening. We have a wedge forming here, and we're looking for a inverse head and shoulders at this point, and I'll show you on the 65 as well. Left shoulder, head, right shoulder. We backed off the neckline already into today, holding that 200-day moving average and starting to get above our trending indicator, that 8-day moving average. So we're holding it today. And this should continue to move as it breaks out and back tested that wedge. And I'll show you a better view of it on the 65. And well, before I move to the 65, we expect either this is a B, C, and we back off maybe into the resistance here. I'll have to extend that. And then we start heading lower. Or this is a 1-2. And if I think the market is as bearish as I think it's going to be at this point, with this information, I think this is a higher low, and we're setting a 1, an impulse 1, a 2, and heading higher. So let's look on a 65 so we can get a good point of view here. After our initial move up, that's our impulse move. We had this corrective move here, and we're breaking out of the wedge, back tested the wedge already, and is sort of building structure here. So we'll see this is sort of a consolidation zone. We should see, if you want to look at this from an inverse head and shoulder point of view, we can draw the point where the neckline is. So that will be our neckline. We have our left shoulder. This is our neckline. Head, right shoulder. This should be a breakout right above this 104.25 area. And that's what we'll be looking at going in tomorrow. This is our major support area that we had the fake break, got back above it, held it again, and we're building structure on top of it. And as soon as we break this zone, that should be liftoff. Sorry about that. I'm drinking some tea here. And then if I show you just from an Elliott wave standpoint, that is the 50% retracement from this initial impulse move up here. That's our 50% retracement that we held. Got underneath, almost touched the 62, but this is our zone. That's a golden zone. That's why it's in yellow, the gold here. And now we're building that structure. And so this is, if we look at, we have this impulse 5-wave move up here for 1 and a 2. You have, again, 1, 2, 3, 4, 5 for a 1 and a 2, making a higher low, starting to build that momentum, build the structure. And you can't really see this one here, but it's certainly impulsive. That was a straight up move here. And we had A, B, C, flat pattern to a 1-2. So we have a 1-2, 1-2, 1-2 setup. That should create enough energy to, and on a lower time frame, this will be the 1-2 here as well. But it should start to move pretty relentless in a wave 3. And like I said, if it's a C or 3, either way, it's going to be an impulse move. So that's what I have to show you. The dollar starts moving up. It's showing us that the market is getting ready to turn. Junk bonds are telling us that the market's getting ready to turn. And the rates are telling us that the market's getting ready to turn. Now, the rates could go either way. As we break to the upside, because we're breaking that, I wasn't planning to bring this out. I don't know if I updated. We have our wedge here. Broke off from the wedge. Look at that. Perfect back test of the wedge. It's going to be bad for the market at first. Maybe all we're doing, and I showed this on a previous video, we had this trend line. Maybe all we're doing is back testing this trend line. But I tell you, once TNX really starts to break to the downside, that's really bad for the market. All right. I know that the yield curve can correct in different ways, but the most popular way for the recession is just the 2-year to head down much faster than the 10-year, and that will be our normalization in the yield curve, which is bringing the recession on. That's what I got for you. Hope this information helps. We will bring another video out tomorrow with hopefully some new indicators for you to see, or some old ones bringing back, and I'll show you and share those indicators with you. So don't forget to like the video. Thank you. Have a wonderful day.